Call to order the City Council Standing Committee on Audit and Fiscal Sustainability at 4:34 p.m. I'll read the land acknowledgement. The City of Albany recognizes that we occupy the land originally protected by the Confederated Villages of Lishan. We acknowledge the genocide that took place on these lands and must make strides to repay the moral debt that is owed to this indigenous people, specifically the Ohlone tribe. We thank them for their contributions, which have transformed our community and will continue to bring forth growth and unity. The City of Albany commits to sustaining ongoing relationships with the tribe and together build a better future for all that now make this their home. City Clerk, can you call roll, please?
Member Jordan?
Here.
Member Mackey?
Here. We'll move on to item 2, approval of action minutes from May 12th, 2025.
I will move approval.
And I'll second.
Committee Member Jordan?
Yes.
And Committee Member Mackey?
Yes.
The motion passes.
Thank you, City Clerk. We'll move on to item 3, public comment. For persons desiring to address the City Council Standing Committee on an item that is not on the agenda, please note that each speaker is limited to 3 minutes. The Brown Act limits the committee's ability to take and/or discuss items that are not on the agenda. Therefore, such items may be referred to staff for comment or to a future agenda. City Clerk, are there any public comments?
No one online. Is there anyone in the public here? Doesn't look like it.
All right, not seeing any public comment, we'll close public comment and move on to item 4, presentations. Item 4-1, presentation by PFM Asset Management on quarterly investment performance for the first and second quarters of 2025.
Good afternoon, folks. It's nice to be with you all again. I hope that folks are staying cool in the warm weather that we're enjoying, hopefully. As the City Clerk is pulling up the presentation, I'll say there's certainly been a lot of developments, right? Some of it quite humdrum, but nonetheless still impactful to the city's investment portfolio. So I'll look forward to speaking about that now here that the slides are up. As usual, we'll speak to the current market themes, which is on the which is on the third page of that report, or fourth page.
Actually, if we could just, it's the quarter ending June 30, 2025.
Oh,
it's the other attachment.
Thank you, Raina. All right, there we go. So the fourth page of this 6:30 PowerPoint. So this is for the period ending June 30th, representing the second quarter performance for the city's investment portfolio. So you can see here, we have some bullets just on our sort of broad, high-level thoughts. The economy continues to chug along, but appears to be cooling. It seems that the market's really focused at this point on inflationary data. That's really what's weighing on consumers and investors. And while it's bounced around a bit, tariffs really are what continues to loom and weigh on folks' feelings and how they're spending in the economy. That all despite some sort of taco rallies that we saw persisting during the quarter. The dot plot, that now is pushing 2 cuts toward the latter part of the year. Market expectations are that should be around October to maybe December at this point in time. The Fed continues to want to see data before they act upon resuming their sort of their easing cycle in lowering rates. Yields moved quite a bunch, frankly, due to the budget bill. The debt ceiling and the tariff talk, and that really fuels a lot of the volatility that we saw during the quarter. That said, 2s and 10s, the sort of ratio of the 2-year Treasury yield to the 10-year Treasury yield, those have begun to steepen, which could be a good sign for perhaps a normalizing economy, that we still continue to see the 3-month Treasury inverted. So that certainly benefits the city and the CAMP account. With volatility, spreads widened during the quarter, and that helped us to uncover quite a few nice opportunities to add nearly $6 million in names to the city's portfolio. The next slide just speaks to the dual mandate. So as a reminder, the Fed has a pretty strict mandate for maintaining maximum goods price affordability and maximum unemployment. And here you can see on the left, core PCE inflation, that's personal consumption expenditures. And the solid blue line represents where we've been, whereas the dashed lighter teal line in the shade shows the expectations as well as what the sort of range of forecasts look like. So you can see the most recent data for May 2025 showed 2.7 core PCE, and that was up from a low of 2.5% in April, but down from a recent high of 2.9% in February. So while it's climbed a bit from the recent low, it's still, inching higher, and the Fed is really looking to that in our view as to whether or not it'll probably begin to move rates. That said, unemployment remarkably still continues to remain relatively low, 4.1%. As of June 2025, there are certainly expectations that will continue to rise, and there's certainly also some talk about the federal budget having some impact on that, particularly with allocations to sort of immigration enforcement activities. The next page speaks to that, and you can see the impacts of what we're calling here the reconciliation bill. It's been popularly called the Big Beautiful Bill. That said, there are remarkable increases to certain priorities of the Republican administration with control of both the executive and legislative branches. And you can see all of the different sort of areas in which we saw growth or reallocations perhaps to these priorities, whether it's armed services, homeland security, decreases to Medicare and Medicaid, decreases to forestry services and other spending cuts. Net, what we see is a total deficit impact of 3.3 trillion out through 2034, so over the next 10 years. With respect to the key ratios that economists and folks look at in determining sort of the viability of the US economy, the right side shows that. So you can see where we've been up through this sort of solid dark blue line, and the forecast for where we're expected to go through the next 10 years in the dashed lighter blue line. We'll see how all of this shakes out with respect to the fundamentals for the U.S. economy. But that said, we did see the Moody's downgrade to the U.S. Credit rating following S&P and Fitch several years ago. So now the U.S. no longer carries a AAA rating, and I'll speak to that in the coming slides. The next slide speaks to tariffs. Thank you. And you can see here how tariffs have kind of bounced around. It's, in my personal view, it's a lot of noise. It's like you wake up, see what happened, and you can see how folks are reacting to what was announced. In aggregate, we saw since the Rose Garden ceremony where the tariffs were announced an effective tariff rate of about 13%. So that was around the late April, early May period. That's really where kind of things landed. As of this week, we're now at an effective tariff rate of about 19%. So I'm just trying to distill it for you all as to where we stand. And all of this really, I think it's clear to me that this adds to a lot of the uncertainty that we continue to see that, don't really support the market and the activities that we're trying to do to, create stability in the city's investment portfolio. So there's, uncertainty, as we've mentioned here, around budget and spending, tax reform, funding freezes, and debt ceiling, and all the sort of tariff talk really kind of, adds fuel to that. Any questions here before I just jump into the kind of the nuances of the Moody's downgrade? Yeah.
Did any analyst detect an impact from the third credit rating agency downgrading U.S. debt? And is there an inversion now that didn't exist before between U.S. debt in terms of the interest it pays and other debt that now has a higher credit rating than U.S. if there is other national credit that has a higher rating than U.S.?
Yeah, I think, that's a great question. So I'll just turn to the next slide.
Okay, sure. I can be your straight person.
Yeah. I mean, so as you all might already know, I'm an ex-Moody's analyst. In my view, Moody's was kind of lagging with respect to, their downgrade on the U.S. Debt. I think the fundamentals for the U.S. economy, particularly related to leverage ratios, debt to GDP, deficit to GDP, really just kind of lagged, and I don't see why Moody's didn't follow in the footsteps of S&P and Fitch, a long time ago. I think a lot of it, frankly, has been priced in, and you now see that, in the Treasury yields, right? We're able to lock in higher sort of coupons for the city with respect to the yields or the treasuries that we're purchasing for the city, which has been great. And I think that really is much more in line with what one might expect to see among a AA1, AA plus rated sovereign entity. With respect to how pricing may change, how interest rates may change, again, I wish I had a great crystal ball for that. That sounds very cliche. And the summary of economic projections that the Fed puts out kind of speaks to some of that with respect to where they think Fed funds target might go. But I think the forecast and most market participants at this point in time don't expect to see an additional downgrade to the U.S. rating. I believe most of the rating agencies either have a stable or positive outlook on the U.S. economy. I don't have that here, but you can see Moody's for sure has a stable outlook at this point in time. So one wouldn't expect, for example, the rating to be downgraded and then potentially interest rates going up.
So if what Moody's did was already priced in, then that would obviously suggest, or considered to be priced in, that would suggest no change in that foundational element of purchasing of U.S. securities as foundational for the portfolio. I'm wondering at the time that the prior two credit agencies did the company, PFMAM, make any changes in terms of that foundation element, look for AAA rated something or other to hedge that increasing risk?
Yeah, I mean, I certainly appreciate that. There are certainly AAA sort of corporate names that are held in the portfolio. There are super nationals that we previously purchased for other jurisdictions here in California. I think it's a great question. I mean, I think if there comes a point in time when the viability of U.S. Treasury debt is in question, if that really arises, I think that would really center around, for example, the debt ceiling sort of issue. A technical default would not be good for any sort of bond or note holder of the U.S. Treasury. We haven't seen that at this point in time, but I don't think that would, for example, cause any rating agency to downgrade the issue further and then, rates to skyrocket, for example. We might see a sort of short-term blip, perhaps, but I can appreciate what you're saying. We're not looking to, for example, reallocate the risk-free asset of the city into, for example, German bonds. That's not our objective at this point in time.
Yeah, that was the crux of the question, not specific German bonds, but just reallocation. Thank you.
Sure. Yeah. So again, this is in my view, somewhat dated news, but certainly helpful as you think about, what you're speaking to, Director Jordan. Just, is there a question about whether or not the U.S. fundamentals really are an issue at this point? And I think that, hopefully there's some stability here, as we see, for example, the executives and the legislators sort of being able to move forward in their priorities. Maybe there's some stability there. Perhaps it's not in line with our personal views, but at the same time, there is stability as we see these things move forward, and that's certainly good for the portfolio. The next page really speaks to, a lot of that. So you can see on the next slide just a sort of illustration on a table as to where we've been and how we think things are beginning to shape out. So here you can see key measures for headline CPI. That's the Consumer Price Index. This is the more familiar measure for inflation, unemployment rate, and then quarterly measures of gross domestic product as well as consumption. So if you draw your eye to the far right side of this table, you can kind of see where you can feel and see where we've been and where, perhaps where we might be headed. So CPI certainly seems to have come down. Rewinding to 2023, think back to long lines at Costco gas, prices really kind of skyrocketing, energy costs really out the window. And now we're at a point in 2025 where, relative to that point in time, things have really kind of stabilized. Unemployment, however, that is starting to pick up, and you can see it's now less green as you move right. Gross domestic product quarter to quarter, we saw negative growth. Certainly there's been additional sort of data from Atlanta Fed Now, which is probably one of the more reliable sources for these forecasts. But you'll see it was negative 0.5 percentage point in the first year of 2025. Consumption quarter to quarter also near zero. And a lot of that really leaning upon the sort of tariff uncertainty that we're seeing. The next slide speaks to the Fed's summary of economic projections. We receive these at the end of each quarter, and this really kind of lends a guide as to what the Fed is thinking as we move forward. I like Fed Chair Powell's quote here. Think of it as the least unlikely path in a situation like this, where uncertainty is high. This is as good of a crystal ball as we can get, I think is what I want to emphasize here. So you can see real GDP toward year end has come down a bit. Unemployment rate has ticked up about 0.1 percentage point to 4.5 by year end. Inflation also, this is personal consumption expenditures. This is the Fed's preferred measure for inflation. That's now at 3% by year end. And then you see here Fed funds rate, right, which might also kind of guide where treasury yields kind of go or borrowing rates might go. You'll see 3.9 continued for year end, and the long-term rate still expected to be around 3.0% through 2028. Rewind a year ago, that was 2.5%, right? So that number is still elevated relative to what the Fed thought about a year ago. The next slide speaks to the dot plot. I think the nice add here, frankly, is that illustration with the arrows on the far left side of the chart. We can actually see now folks are thinking 2 cuts. It wasn't so clear last quarter. Previously, we saw no cuts. Now we're seeing about 2 cuts by year end. So perhaps we might see 1 or 2 by the end of the year. Market participants on the institutional side are anticipating 1 to 2 cuts, again, between October and December of this year. The next slide speaks to the yield curve. You can see where we ended the quarter in the solid blue line. The prior quarter was the dashed line, and the year range is in the shaded area. The city continues to benefit from overnight rates with that 4.29 yield on 3-month treasuries. And then you'll see here the continued steepening, the 2s to 10s at 3.72 to 4.23, and that's a bit steeper relative to where we ended last quarter. So, I think the key takeaway here, despite all the noise, despite how we feel about the budget, all the sort of noise surrounding tariffs, the Moody's downgrade, this is still a remarkably good time to be purchasing fixed income assets for the city's investment portfolio. This next slide just shows the volatility that we saw in the 2-year. We like to use this as the benchmark for the, as a sort of benchmark for the city's investment portfolio, as its current maturity, effective maturity is about 2.08 years. So the 2-year treasury yield is a nice sort of bogey if you want to put that on your home screen for your phone. Here you can see, all the different sort of announcements, reciprocal tariffs really driving a ton of volatility in the market. Payrolls, the Moody's downgrade, and then the wars in the Middle East between Iran and Israel. This next slide is a new slide, which I actually personally really like. We've spoken about spreads previously. Here you can actually see by the color coding how spread sort of tightening and widening has benefited the city's portfolio. right? So in the red, prior to, call it April of 2025, the sort of, prior to the first part of the quarter, you can see underperformance indicated by when spreads were either, were pretty tight. Once they rose, we then now benefited in that we were able to sort of, park money in, make some purchases, and then we see outperformance with those spreads widening. So this is a sort of, in my view, a nicer illustration for how we think about actively managing the city's portfolios, specifically with respect to corporate holdings as well as asset-backed holdings. And then the next couple slides, you'll see this first one shows the year in spreads, and then the next slide speaks to the quarter in specific. You can see the 1 year range by the black dashed line, and you can see how spreads have sort of widened in the beginning of the quarter, as we spoke to in the 2 slides ago, and then really tightened coming closer to zero, making it a bit tougher to perhaps find opportunities to purchase for the city's investment portfolio. Lastly, on the market and economy, I'll speak to total returns. The scales are different, right? I know that we have a few tables here. The scales are different, but the takeaway on this slide is that fixed income continues to perform. In the second quarter alone, we saw 1.36% return for U.S. Treasuries. Year to date, so the first 2 quarters of the year, we saw 3.39. And over the past year, we saw over 6%. And this is for a 1 to 5 strategy, pretty much in line with the city's investment portfolio. So, 6%, I mean, geez, that, to me, again, this is a great time to be buying bonds. I mean, the really nice thing about it is there is predictable interest income from the securities that we purchase for the city. And then at the end of the day, once all the money is recouped, we earn back the principal that we've invested. So, I hope that this quells any sort of fears with respect to the volatility, perhaps some of the things we've seen on the equity markets. Those are not the same here. We don't have, stocks or Tesla stocks, anything like that in the city's portfolio. These are purely fixed income assets. Any questions before I turn to the city's investment portfolio specifically? Okay. So there's some additional commentary on the next couple slides. We also have an outlook, 2 more slides down, that sort of speaks to how we feel about certain sectors. Nothing has really changed here. Factors to consider is the next slide. Nothing really changing here at this point, though everything is, a bit neutral. Perhaps we're seeing some stability at this point in time, but, just like the Fed, I think we're really all waiting to see the first cracks with respect to, potentially unemployment or inflation. But I think the latter is really where we'll start to see some Fed action. 2 slides forward, please. You can see the account summary here. The main key takeaway I'll point out is the amortized cost of $32.4 million at the end of June, and also the CAMP 7-day yield. So that was 4.43. Again, with the inverted yield curve, you can really see the benefit to the short-term local government investment pool that the city invests in. That continues to generate meaningful interest on the city's overnight money. The next slide shows a portfolio snapshot, and you can see here 33 point. The next slide. I think because of the zoom, it might have. There we go. So here you can see the snapshot. Total market value of $33 million. Portfolio duration, as we navigate the volatility, our main goal is to remain pretty close to the portfolio benchmark effective duration. So it's now at about 101% of the benchmark. So it's 2.08 years relative to 2.05 for the benchmark. Yield at cost, that is 4.58. That's essentially the yield on the portfolio as we purchased it over time, including all the sort of accrued interest, pay downs and the like over the life of the bonds as if we hold them to maturity. When we think about yield at market, that's 4.21%. That is the yield of the portfolio if we sold it entirely at June 30th. again, pretty remarkably high for the sort of environment that we're in. Credit ratings on the portfolio, 61% rated AA and higher by S&P. And then I'll speak to sector allocations in a moment. And you can see duration distribution generally in line with the benchmark. So if you go down to the next slide, you'll see issuer diversification on the next 2 pages, and these highlight all of the individual names that are held in the city's portfolio on an aggregate sort of basis. There's QSIP level data on the following pages that I invite you to look at your leisure. But the next slide, showing sector allocation review, I think is most illustrative of the diversification strategy that we deploy on the city's behalf. So here you can see the sort of changes over time back to September 2024 in the sort of, the tabular data at the top, as well as the color-coded bars at the bottom. I think the key takeaway here for me is you can see a preference for us to move into the risk-free asset, the U.S. Treasury securities, over the past several periods as we've entered this sort of period of volatility, beginning with, the election and out through, the period we are today with, all the sort of activities I've spoken about previously. You can see U.S. Treasuries now account for 25.9% of the city's portfolio, and that's up from 17.8%. And, in accordance with that, certain sort of other spread product, other fixed income assets have been drawn down a bit. The next slide shows portfolio activity. Net, we made about $8.5 million in new purchases with, positive yield at markets, I want to say ranging close to 4.5%. Many familiar names in the portfolio, including a number of banks as well as asset-backed securities. So, if you have any questions about those, I'm certainly happy to go through those. But all of these continue to be on the U.S. Bancorp's approved list with respect to fundamental credit and continue to pay, so they're money good. The last slide that I'll speak to now speaks to portfolio performance. This quarter, you can see $301,000 in interest earned during the 3-month period, positive change in market value of $188,000, and total dollars returned of $490,000 in the quarter alone. The portfolio generated 1.50% and outperformed the benchmark of 1.28% by 22 basis points. So I'm thrilled that we're able to show outperformance this quarter. As I've mentioned in previous meetings, interest earned continues to be very meaningful. You can see here the annualized figure, $1.159 million generated over the past year. On a quarterly basis, that's $289,000. We've now crossed that, and we're at $301,000. So again, these, despite all the volatility, all the noise that we've talked about, interest continues to be very meaningful that are earned on the city's investment portfolio. And during the year, outperformance by 58 basis points, which, I think is remarkably good. So that wraps up my prepared remarks on the investment portfolio and the economy, and I'll invite any other questions you folks have.
Any other questions? All right. Not seeing any other council questions, I'll open it up for public comment. No public comment in the room. Any online?
None online.
Yep.
Is this the yield curve?
Yeah, I just want to know why it's a straight line.
Straight line?
That's a joke, Justin.
Oh. Thank you.
So not seeing any other public comment, we'll bring it back for discussion.
I think other than thank you for your work, and thank you, staff, for moving us to this model.
Thank you.
Okay. I think, should I remain up here? Or-
Sure.
Okay, I'm going to sit back down. Let me know when you need me.
Okay. With that, we'll close item 4-1 and we'll move on to 5-1, follow-up discussion on environmental, social, and governance, investment strategies and options. Staff?
Thank you, committee members. Raina Schwartz, your finance director and city treasurer. Get both of my titles in there, I guess, for the purposes of this part of the conversation. The item 4.2 is a review a little bit of where we've been on the topic of environmental, social, governance investing, ESG investing, with some of the materials that we have provided in a couple of the prior meetings, but also some additional information and laying out options of some ways that the city could move forward potentially with an ESG investing strategy. And if the clerk could pull up the first attachment on the ESG options, which looks like that. Excellent. So there are basically 3 options that PFM has identified for us, which basically, and on the second page of that, there's a chart that sort of summarizes it a little bit more. We may have to go back to the prior page. But there are 2 options that are based on what we would call negative screening. So here's the things we want you to take out of the portfolio. One option that is based largely on positive screening. Here are the things we want you to include in the portfolio. There are also different data sources. Bloomberg, which provides business and industry data, no rankings on an ESG basis, but it is also a free service, so it doesn't add to potential costs for the city to have those choices made under the Bloomberg data. Option B brings in the use of Sustainalytics or an ESG focus to help refine the implications for ESG investing, looking at revenue, what percentage of the issuer's revenue is associated with a particular industry or sub-industry. So there are a number of very large companies, financial companies, et cetera, who may have, they may invest in companies down the line that have some characteristics in industries that might, ultimately the council might choose not to invest in, but it might be a very, very small percentage. And now we're talking a tiny percentage of a tiny percentage of a tiny percentage. So the revenue measure helps us understand just how much of an influence something might have in the portfolio. And that has a particular fee structure on top of our basic current management fee. Option C brings in this positive screening using Sustainalytics, which is the product that PFMAM uses, which can be then matched with some other exclusionary type or refining options. But basically, it starts with that Sustainalytics ESG function. So if you go back to the prior page at the bottom. Excellent. So these were for sub-options. I was having trouble. I was numbering them. I was lettering them. I was trying to make them easy to mix and match. But in any case, 4 sort of sub-options for using the Sustainalytics data. One is just limit eligibility to issuers with medium or lower ESG ratings. Boom. Second is a relative rating. Medium or lower rating, but any investment also has to be in the top half of their sub-industry. So if there are 10 issuers in a particular sub-industry that are approved, we would be providing direction at that point to only invest in those that are in the 5 lowest scores of those 10. Universal rating, which is the first one, with exception. So you could exclude, or you could include high ESG risk number investments, but only if the issuer is in the top quarter of the sub-industry, or a bit of a mix and match, which would select moderate or lower risk factors, but some level of refinement and have that top half of their sub-industry. So 2 and 4 are very similar, and I realize now that actually it's probably C4 that I meant to include as the recommendation, but I'll come to that in a moment. The fees that you saw on the next page are essentially a reflection of the complexity of the investing strategy. So the more mix and match, the more components to it, there are some additional fees that come as a result of that. In looking at a potential recommendation, the analysis on our part was, how do we try to make some forward movement on reflecting ESG criteria in our investing, and at the same time balance that with simplicity/cost, more simple, less costly, less simple, more costly. And while there are some characteristics that may be the council ultimately wants to focus most on, that may be where those ultimate refinements come in. So the recommendation, trying to balance all those pieces, is to use a base of something like Sustainalytics that provides a broad, well-rounded approach, or at least a broad approach to ESG criteria, but not to overly complicate it, which will make it somewhat more cost-effective, but also just easier to manage over time. And the recommendation would be C4. I had C2 in the report. I apologize for that. But really, using low or moderate risk scores, or moderate or lower risk scores, along with a kind of picking the cream of the crop by sub-industry. So you want those that minimize the risk out of those high-risk categories, but also provide the best of those subcategories. The other attachment to your report just identified what portions of the portfolio are, or of the maximum authorized investments, are knocked off by each of those strategies. Basically, at low or moderate risk levels under an ESG model, the vast majority of the portfolio is still eligible, those approved investments. So you don't lose a lot of flexibility by staying with a low or moderate. If you went to a low or lower, lower negligible, you would lose about half of, just as a point of context, you would lose about half of those authorized issuers. We have had some conversation about, could we sort of try to thread the needle in between those two, low and moderate. The way that the Sustainalytics models are set up, and the agreements that PFM has, and the way that they work with that, basically they've said we kind of need to stick in the low or moderate, but we can use these other tools, other levers, to try to help refine those categories to more closely match what ultimately the council is trying to achieve. With that, I'm going to end my presentation. I am here for really easy questions, and your PFMAM advisor is here for all the really hard questions.
I'll open it up to council questions.
Thank you. Thank you, Director. And this might be more on the hard question side. I had asked about the possibility of setting a score, an total ESG score that would screen at the 75th percentile level. And my inspiration for doing that was a model that was shown in March, which was doing low, medium on ESG score, and then I think a score of 8 on the E score. Which I then learned the E-scores are not publicly available and so wouldn't be so transparent. So I thought, I don't know if 8 on the E-score is like some moderate low on the E-score, if it's categorical or an actual numerical score you're screening for. But if it'd be possible to screen, obviously my interest is making it as simple as possible, as transparent as possible. And so if we just had one total ESG score we screened on, and it was 75th percentile, so we're just screening off the top 25%. In the model that was presented in March, it was the top 20, or it was 22% that were screened out. And so it would sort of follow that example. But I think I'm hearing now, maybe not, but I'm going to ask again because that's my hope, because I think that's the simplest approach.
Yeah, I completely understand your concern. We've talked about this with the head of our sustainability sort of products. We understand that's something that the city wants to consider, but unfortunately we can't offer that. At this point in time, the way that we view the sort of Sustainalytics ESG related scoring is as a point in time measurement at the time of purchase. That's when we can enforce the rules. With respect to a sort of fluid sort of monitoring, we can offer that. But with respect to guaranteeing, for example, that the score is going to stay at, a certain level.
Maybe I could jump in. So yeah, I'm not, so that was my question. It would be at the time of purchase. So we would, at this point in time, based on the approved companies, you look at the range and you figure out where the 70th percentile score is, and that would be the score. And if it's below that score at time of purchase, at the time of interest in purchase, then you'd purchase. And if it was above, it wouldn't. And I understand it would change in the future. I'm just saying for simplicity's sake to have, say it's 27, 26.5, I don't know, 27.5, I don't know what it is, but just to establish a score once and then just hold that score for purchase decisions only. So if that company goes up over time, if companies come down, obviously they come down and you look at purchasing them later, then you'd purchase. But if they go up after purchase, then it would not affect that past purchase. So it's only at the time of purchase. And I presume you have the scores as opposed to the categories. So if you could just do a one-time look to see where the 75th percentile cut is, then we could embed that in our investment policy and revisit it, when we revisit it each year, because that might change a little bit. But that would be the score, the threshold, for the rest of the year.
I appreciate your clarification there. Thank you for offering that. With respect to assessing an ESG score on a percentage basis or a quartile basis, whatever it might be, unfortunately we can't do that. The way that it's set up currently is by these sort of negligible, low, high, severe, etc. buckets, which I know doesn't exactly meet what you're speaking to, and I know that I understand from your perspective these sort of 10-point scores, these 10-point categories don't meet perhaps what you're trying to achieve, but unfortunately at this point in time we don't offer that.
Okay, well, yeah, I guess just.
But I'll take that feedback because I know
because
that's what you guys want. So
these categories are so, 2 of them are so broad and 2 of them are so small, or 3 of them are so small, they're almost meaningless. I mean, you got 50%, 40 to 50% in 2 of the categories, and then under 10% to 1% in the other 3, and so they don't provide much granularity. So I think they should redefine where they cut their categories at, what score they cut their categories at. But Obviously, we're not gonna do that tonight. So
And I can promise you that I'm going to bring this feedback
Sure.
to our folks, and as this is a living document, right? This is a living sort of activity. Things are going to change, and I'll certainly present hopefully a point in time when we'll have this data. But I don't know, and I can't make that promise. But I promise to keep it a close ear to the ground for you all.
And again, my interest is simplicity, so that would be, to my mind, simpler than anything else that was proposed, where you're considering this and that, and this and that, and some negative, some positive screens, with combining. I think it'd be easiest for the public to understand. I think it would be easier to implement, ultimately. Thank you. I need to go back and figure out which model, given that.
I don't, do you have additional questions, or would you like me to?
Please go ahead.
So again, thank you, staff. Thank you, consultants, for providing this. I think, I guess I don't really have a question at this point. So I can stall a little bit longer, Preston, or we can move to public.
No, I don't have other questions. I'm
Okay.
gonna have to figure out, given that I just learned this is impossible, which I have been asking about for a while, figure out which other way to go.
Okay.
Thanks.
So with that, then I will open it to public comment, and do we have a sense of how many people online? Okay, so we'll go ahead with 3 minutes then, and we'll start in the room.
So appreciate the presentations and the work you guys have done. My main problem, if you read my email comments, is around this focus on the mechanics really isn't getting, well, there's two problems. First, I'll speak to that, but we need a statement of principles, and I think that's been neglected. There's models out there about how we make human rights a priority in our values. And so I'd like to see you guys focus a little bit on that today, about crafting a statement of, what do we want this policy to do, and then how are we asking our investment manager to implement that. And so that's the first thing. And the second thing is, again, I'm going to go back to Sustainalytics. I'm reminded of the time when I'm a kid, and we used to take vacations from Chicago, where I grew up, to my cousins in New Jersey. That was my vacations. And we would be driving near New York, and I would ask my mom, can we go see the Statue of Liberty? And she would say, we'll see. And then we'd fall asleep, and I'd wake up in New Jersey, and I never saw the Statue of Liberty. I'm sort of feeling that way about this. When I saw the memo, and maybe I'm misreading a little bit about it, and when I heard Finance Director explain it a little bit, I think those other measures would include this, what we've been proposing and advocating for, which is a process by which we can identify specific companies. And I use Lockheed Martin, Caterpillar as examples. I looked at the ESG ratings for, from the tool. For Lockheed Martin, it's actually lower than it was. And this is after another, 4 or 5 months of genocide that they're participating in. Just as an example of why this tool cannot be relied on to give us the full breadth of view of the aspects we want to consider in this policy. If we really want to make it meaningful, we have to take that extra step. Allow the community to participate, identify specific companies, and exclude them specifically, and then ask Justin and his team to take whatever steps they need to remove them from investing, from the portfolio. Lockheed's still in there, Caterpillar's in there. Chevron, I don't know if we're going to go with the blended. I mean, Chevron might be too high to begin with. It might be one that's excluded. I haven't looked at the rating for that. But again, the tool is fine. We don't have a problem with the tool. A review when we meet here every quarter. We're all getting to know each other pretty well. It's like my third time I've been here with Justin. So, we can have that review in the community. It doesn't have to just be me. I'm sure you're tired of hearing me. But other people can come in. We can have this discussion. We can raise awareness about what's going on in the world, okay? Rather than just relying on a tool to do that for us blindly. I think there's a lot of value in that. Thanks.
I would like to reiterate what Peter said and what we have been saying for the last year, and that is that we'd like to see a statement added to the Albany investment policy that aligns with our shared values. And that's basically to put in the social responsibility section 2 of the investment policy, add a sentence that says we're going to avoid investment in companies profiting from human rights abuses, war crimes, and crimes against humanity. We don't see that in the statement yet. And I'm assuming those are our shared values. In other words, we don't want to make money from war. Next, use the quarterly performance review by the investment managers to discuss exclusions of companies that do not align with our shared values as stated in our social responsibility section, period. That's all we need to do. Otherwise, if we don't have that, we can go ahead and invest in all our money in Lockheed because genocide and ethnic cleansing is a very good moneymaker. Thank you.
Thank you for your comments.
Just going to reiterate Peter's and Haganush's points on the need for this statement of shared values. We are not taking a particularly high moral position. We are not asking Albany to try to end this genocide. We are asking Albany not to make any money from it. And I'm not sure how, they can go on doing all their war crimes, but we will not have part in it. So it's not the highest moral ground. We did make something like that earlier when we asked for or demanded a ceasefire, a real end to the killing. So this is a step down, but again, an important step down. And on the issue of whether this increases the workload or the costs or reduces the monetary return, we're calling for that. If that's what it means, that's not that big of an issue. And of course, as we know, the two major companies, Lockheed Martin and Caterpillar, are the ones we've been focusing on exactly that issue. And it shouldn't be that, just from the outside, it just doesn't look like that big of an issue to allow for a review above and beyond what Sustainalytics, where they're completely inadequate on this issue. And again, last point, it is not just human rights abuses, it is war crimes and crimes against humanity. Those things are happening. People are making money from it, especially Lockheed Martin. And so let's not leave that unstated and perhaps debated sometime in the future. It's there, and we know exactly who are accused of war crimes. Okay, thank you.
Thank you for your comments.
Hi, my name is Amber. I'm an Albany resident, and I don't have anything to add. I just wanted to amplify what the previous three speakers have said. We really appreciate you bringing this up for review and talking about it, and it deserves some stronger words. It deserves some clarity to really lay out what our values are. And yeah, that is about it. I think it should say explicitly that we don't support financially, we don't make money off of crimes against humanity, genocide, and it shouldn't have to be stated, but this is the world that we're in, and this is the landscape that our country is in, and it's at a local level where we can push back. So thank you.
Thank you for your comments. Seeing no further public comment, I'll close the public comment, bring it back for discussion. Yes.
If I might just point out maybe one little needle threading option to start your conversation. If the committee/council wanted to move forward with the ESG option, either C1 or C4, C2, that could be combined with a specific negative screening for Lockheed and Caterpillar. Boom, done. And in the realm of trying to maintain some broad perspective as well as some simplicity and some clarity, that is another option that Justin is nodding good. I haven't misinterpreted all of the conversations I've had with him, but that is absolutely an option and would come together relatively straightforwardly.
Thank you, Director Schwartz. That was going to be one of my questions. So it's just that I want probably maybe more clarification. The way I had read the staff memo was that option C would still allow us to exclude subcategories if we wanted to. So we could choose 1, 2, 3, or 4, but we could say we're just going to not include anything that has to do with military complex, industrial minerals. But what I appreciate with your comment there is that we could also then include particular company if that were staff's, subcommittee's direction.
Yes, and in some cases, those industries or sub-industries have a wide variety of firms. Some of them might include a Lockheed or a Caterpillar, but also include companies that you wouldn't necessarily otherwise perhaps want to exclude. So a C4, which gives you sort of the best rated of those in the low, moderate or lower category, you're still building a pretty good base, and then you would be able to do the more refined targeting of particular companies rather than necessarily focusing on an industry which might or might not be too broad for what you're trying to achieve.
Thank you. I move that. We recommend what the director.
So I was going to say something similar, but I think we probably do need to enunciate more clearly.
Sure. So it would be recommended to council that in terms of the technical side, and I'll get to the value side, and I appreciate people commenting to that. I apologize, I haven't focused on that, being kind of a more technical person. We recommend the approach of option 4 under alternative C, I guess, and with the addition that specific companies beyond that could be designated for exclusion. I think if we're going to recommend specific companies at this point in time, then we would need to have, between you and me or something, we would need to write something up for the council in that regard. But I think in terms of the policy perspective, because it's not just about those companies, there might be other companies that come forward, we would have this sort of exceptional exclusion option built into our policy.
And then, so agree with those points. And then, sorry, I'm going to just respond maybe to the public comment about the statement. I actually don't think we can talk about editing the statement today because it's not in our agenda. Mm-hmm. So that will come up. I do not see a future agenda item list here, but I will note that to staff that on a future agenda, I would like us to come back to the statement just to address that. I mean, I would be prepared to go to council saying that we would like to, in the sub-industries, because we've talked about the sub-industries so many times, essentially it had to do with them as listed in the staff, kind of in the background, just the arms industry, mm-hmm. right? And I leave it to the consultants and staff to help us on exactly what that term is. So when it goes to council, it is those industries, and then include Caterpillar in that. And I think move forward with that. I would also ask that there was a request from the public that this be quarterly reviewed. I don't think that's. I think it is something that we would review annually. In terms of the list, like if we were to change the list, because I think quarterly would be be every third meeting that we'd be doing that. And I think that might be a much bigger ask than is reasonable. I think we could, as a subcommittee, say, something crazy in the world has happened, we would like to review it sooner, but I don't think we should assume that we're going to review it quarterly. I also don't know if this is allowed to be talked about, because it's...
I think it would be part of the policy.
Oh, okay.
So, I mean, given that we, as a body, consider the investment portfolio quarterly, I think it's as simple as a matter of seeing what new, if any, companies have been invested in, noting those, and thinking about that, and hearing perhaps from other people about those companies.
Sorry, so I agree with that, because
Okay.
we'll know what's been invested.
Right.
But that every quarter, we would be reviewing the world of companies that we might want to exclude, that we haven't actually invested in. That would be...
So that to me is intractable, because as I understand it, the universe of companies that have been approved for investment is approximately 300.
Yeah.
I don't know how many companies are traded, 10,000, I don't know. We're not going to review 10,000 companies and figure out.
We're also not going to necessarily review all 300. My understanding is those 300, the companies that we can invest in change, right? It's not a static thing.
And we don't have access to that data.
Yeah, and so like,
So to me, it's untenable.
I see. That's
It
where
can
you go
only
with
be
the untenable
backwards
part.
looking.
I see.
So the only time we're going to know.
Okay. And so,
Yeah.
but that also probably why I would say we should be a little bit broad generally with the categories, right? Because as a general rule, those are probably not companies that we want to be investing in. It does potentially leave some companies out there that maybe we would be okay with. Because otherwise, we will have invested and then realized that we didn't want to invest in
Right.
that company if we, so I'm just saying, like, one of the comments was, one of the questions was specify Lockheed. Well, if we specify Lockheed, that's great, but, you know, what if, I don't know, some other company is added to the list and then we accidentally invest in it? So that is part of the reason why I would like us to go ahead with subcategories.
Okay.
And then we can specifically call out other companies if we find out we invested it and it's not in that subcategory and we feel that there's an issue.
So if I can frame what I think I'm
Yes, please.
understanding. Okay,
Yes,
so
please.
it'd be C4,
Yes.
with the exclusion of defense as I think it's sub-industry, because the industry is aerospace and defense, and that includes
Correct.
like Airbus and Boeing, and so it would be defense, and then I would like to add oil and gas as an industry.
I think I would be comfortable with that. I think we have the option of always reviewing this every year. You had particularly brought up some oil and gas companies that might be or doing a better job, but that's okay. I'll stick with the simple right now.
Right. I mean, if we're going to go with simple, I
Yeah.
mean, that was why I wanted to go with like just the
Yeah.
75% screen, if there were some companies that were, but
Yeah.
given that we're making the best we can with what the options we have.
If I might just interject, because we're using the industry and sub-industry definitions that have been given to us by the financial universe, so
Yeah.
none of us are going to change
Right.
that right at the moment. Aerospace and defense is an industry, and it is its own sub-industry.
Okay.
It is not splittable
Okay.
between aerospace and defense.
Right,
So
okay.
if you say aerospace and defense, the sub-industry is aerospace and defense. So just wanted to make sure that you had that, because,
Yeah, I couldn't remember if it was oil and gas that had the same sub-industry.
no,
as
oil and gas
oil and gas.
has,
like
oil
drilling
and gas has a
service.
whole, oil and gas has energy services. There are actually three industries: energy services, oil and gas producers, refiners, and pipelines. And each of those has 2 or 3 sub-industries. So there is a
lot more granularity on that side.
There is a much more granularity on that side than there is on the aerospace and defense side. Those were included in the slides in the March presentation, which is the only reason I have any ability to give you that information. But if you're looking for sub-industries, you've got some choices on the energy side, but not on the aerospace and defense side.
So we do the sub-industry of oil and gas, not refining, not energy services, but oil and gas.
Producers,
Producers, yes.
which is,
Because there are refiners that produce renewable biodiesel. I mean, there's refiners refining any liquid fuel at all, and I don't know what energy services includes. I mean, if that.
oil and gas drilling, oil and gas equipment.
That's what energy services includes? I mean,
Yes.
okay, then, yeah, I would exclude that as well. So it'd be not refining, but the other two.
So energy services as an industry
Yes.
and oil and gas producers
Yes.
as an industry
Right.
and all of their sub-industries.
Right.
Correct.
Okay.
Then refining would not be excluded, would be subject to the, yeah, has to be in the best half of that industry under C4. Thank you.
And I'm sorry, if I may also, I understand the commitments that you'll want to express in the investment policy itself. Our general recommendation to clients is that an ESG or sustainable investing policy be separately created but referenced in the investment policy. That's our general preference, because the investment policy generally only comes to council once a year. As a matter of just process, procedure, policy, I mean, to bring, for example, an ESG or sustainable investing policy more frequently, or if you want to add or remove names, if you want it to be as, active as perhaps maybe what I'm sensing here, we would suggest not including it in the investment policy itself. Just throwing it out there. As I look to other jurisdictions that we work with, for example, there's one in the East Bay that's been notable in excluding specific company names. We can accept, for example, a sort of letter of instruction. It doesn't even have to be in a policy. As your investment advisor, as your fiduciary, if we are directed, by you all, we must act. So it doesn't necessarily have to be codified so formally in the investment policy itself. And Raina, I'll invite you to chime in further if you need.
Can I ask a question?
And
Raina,
it's
before you-
prospective, if I can just say, based on, if there was a desire to remove a company, a sub-industry, anything more frequently, we would be able to evaluate what the maturity range is for anything that falls into that category, and it is likely that there could be a negative impact of getting rid of that investment sooner. So the default will be that it will stop and not be done prospectively, but that it is unlikely, unless there happens to be a really great opportunity to just make a whole bunch of money and run with it by getting out of something, that it would only be done prospectively from a purchase standpoint forward. So just to clarify that.
You ask your question, I'm going to follow up on that.
Thank you. Yes, now
You
I
want
have
to go ahead?
So I was going to say, thank you for that clarification. I think that, given previous conversation, had been my initial understanding, that it's just we would no longer further invest in that company, we would halt, and that before we sold anything, we'd have to understand the financial impacts. So now I'm going to come back this way and just say, so if I'm understanding what you're saying correctly, is we could give you a letter of intent today that says we don't want you to invest in these subcategories, that we want you to actually do C4 with these things and not have it be the policy, but just go ahead and do that, so that wait a minute. Wait.
Okay.
Is the policy C4, right? And then the letter of intent that's where we would specify the companies or the industries. Is that what you're saying? Sorry, I'm trying to understand, because you were saying don't mix the two.
So the investment policy that we have would be amended to include a section that says, we're going to do some ESG investing, see ESG policy.
Okay.
That's all that has
Perfect.
to change by.
Okay.
The ESG policy would then say the equivalent of C4, with some other stuff in it. And so those are the two policies. That's how they're linked. That's how they interact. And any direction that we would give outside of the direction that is essentially embodied in the first ESG policy that's adopted would have to come from the council as a whole. It couldn't come from the staff alone. It couldn't come from this committee alone. It would have to come from the council as a whole.
That's what I was going to say, so I don't know if it matters where it lands because the council still has to approve it, so I think the recommendation's fine, but in the end, something has to go to the council and the council has to approve it. So yeah, whether it's just a reference, the investment policy to an ESG policy or implementation policy, it's standing aside, it's fine. In terms of sale, so I think I looked at Lockheed in the portfolio, and what I recall, I haven't looked at it recently, the maturity was 2029. And so I do have some question about holding it until 2029, but I don't know if we want to have that conversation, but I guess worth asking. I mean, could we put and you might have to take this question forward to the next meeting, because I'm not suggesting we settle on this tonight, but if we had a sell by 1 year from now, look for an opportunity to sell in the next year or 2 years, pick your number, how would that strike our portfolio manager?
Yeah, I appreciate that. Any holding that hasn't hit maturity is certainly under par. I don't know if this holding is specifically Lockheed Martin. I see one QSIP at least at this point in time. I don't know if it is currently, if it were sold today, would have been at a loss. I don't know. I don't have that information right now. If it's at a gain and we can, make it happen right away, we're happy to advise staff, and then, I don't know, we can advise.
I guess what I'm getting is I was thinking, is there kind of a more general something we could adopt? But I think what I'm getting is it's case by case. So that the just for sake of discussion, the direction can be we would like the manager to look for an opportune time or look at the possibility of selling Lockheed and advise us on does that make sense now? Does it seem like it's going to make sense in some window or something? So there'll be a dialogue around that.
Yeah, I've also seen certain policies here in California related to credit ratings. For example, if a credit rating falls below a certain threshold, we must offer, XYZ metrics to you all, and then staff/subcommittee decides whether or not we must sell a holding.
Yeah.
Because certainly there's, I don't mean to, diminish any of the discussion around what we're talking about, but there are also financial considerations with respect to, any potential loss, how close we are to maturity, those sorts of concerns really also should be considered, I think. We should encourage you all to consider those in addition to, your voice priorities.
In fact, our duty to consider it.
So, if we were to give instructions that we no longer want to invest in aerospace and defense and the oil and gas sides, could that instructions also include instructions to you all that you wouldn't have to come back to us that would say something to the effect of, if an opportunity to sell existing holdings presents itself to which there was not a loss, right, that you could just execute that? Because I assume it's the kind of thing where if you had to come back to council to ask permission to sell it, by the time you go back, you may not be able to sell it at that same price. Am I making any sense? Does it fluctuate that quickly, or is it, sorry? Yeah, right now.
If I'm understanding your question, you all make a recommendation, we bring it forward to council, council adopts a policy that says no energy services, oil and gas producers, aerospace and defense, and embodies in the ESG policy for those choices that are in this initial instruction that if there are holdings in those categories in the portfolio at the time of the adoption of the policy, that if there exists an opportunity to turn that more quickly than the existing maturity without a negative financial consequence, the city would like PFMAM to do that. I think that's a general statement that could be embodied in an ESG policy. Good, he's nodding, I like that. So that we could have that general caveat or instruction for things that we hold the day the policy is adopted. We're going to look to maybe transition those more quickly if it doesn't create a financial detriment. Otherwise, we'll hold it to maturity, but we are stopped as of that day from any future investments in those things that we're choosing not to.
Right.
We could absolutely write it that way, and I believe that that would provide sufficient clarity to PFMAM, and it would not require a return trip through a process that would take longer than it might make sense based on, market conditions changing. The other thing that I'll just add that's somewhat related to this is if the committee and ultimately the council moves forward with what we're calling C4, which is an explosive, which sounds
Yeah, not
like a
great.
really terrible
I was saying
idea. So
Part 4 of Part C as opposed to.
right, part 4 of Part C. I should have numbered and lettered them in the other order. I went round and round on that. And I lost my train of thought as a result of that.
But Director, I would say yes, that is what I was thinking. It would be, I would like to include that kind of language because it's like, if you can sell it and we're not going to take a loss, go ahead and do it. Because we as a group can then tell council, hey, we think we really should divest from Lockheed and we are going to take this kind of hit. But that's a separate conversation, right? Like versus like, if you can sell it and we're not going to take a loss, just do it because we don't want to be invested. Okay.
And I guess I'll just also add, other jurisdiction that I've mentioned earlier that have divested from specific names, they asked us to sell right away, and they whatever consequences arose from that arose. And again, we're as your advisor, as your fiduciary, we must act on whatever you tell us to do. So we're happy to do that too. But we appreciate your collaboration and what Rain is speaking to.
And you will be getting ESG, I remembered. If we move forward with this fourth portion of option C, we will receive quarterly, in addition to the investment updates as you have been experiencing them, there will be ESG reporting that occurs as well. So you will have some regular visibility to the universe of things happening in that ESG system, which may spark additional questions or information, et cetera. But that will be part of it. So there is that also built into the structure of if we move forward with this collection of pieces with PFMAM.
Typically, we don't open it up back up to public comment. Peter, sorry. Did Peter? This is one of those tricky situations where allowing a member of the public to enter additional public comment really has a detrimental potential for a cascade effect. And I'm going to stick with general rules of the way that we run the meetings and not return for public comments. Apologies, Peter. I will say, though, that when this comes to council, it would, because you will have a sense of what corporations we might have to divest, I think it would be helpful for the council as a whole to hear if you were to, because council might decide something different, if you were to tell me to sell it today, this is what it would have cost us last time we checked on the market, right? Like what it would have cost the city, right? Because some metric, right? Because I don't know what council will do as a whole, but it would be good to have that as a barometer of potential impact, with the caveats that by the time the council makes a decision, the market might have changed. So, but at least it's it's an understanding of general amount of loss that we might be considering.
I'm be concerned about doing that because we're not recommending as a committee selling right away. And I understand you're
Okay.
saying some may say sell right away, but I would like to put it on them because I'm afraid if this comes forward with, and here's the loss if you decide to sell right away, that it could easily get confused as, oh, you're recommending we sell right away, and therefore we're going to not pass the whole policy.
And as such, should a council member request that, it could be that we ask to
Hold it over. I mean,
hold it over.
Yeah.
Sorry, I was thinking of the term. I couldn't remember the term of,
Yeah, no problem.
for more information.
Yeah.
Okay. Let's leave it that way. Then the consultants don't have to do extra work until it's asked of them by another council member, because I'm not asking for that.
Yeah.
Sorry, I was proactively asking that, assuming another council member would ask.
Would
them.
ask for it, sure.
Let's not do that.
Okay.
Okay. So I am willing to entertain a motion.
Make a motion. I'll try to make a motion. So the committee recommends part 4 of option C with the exclusion of, in addition with the exclusion of aerospace and defense industries and the oil and gas production industry and the energy services industry, as well as the opportunity to designate additional companies that have shown up as being purchased in the portfolio as being excluded from further purchase. And with the addition of direction to the portfolio manager to look for opportunities that are responsible in terms of not incurring a financial loss for selling holdings in companies that have now been excluded. I'm not sure I got it all.
So that covers, I think, the core. I think and that leaves the option for council to discuss potential, for instance, Caterpillar
Yes.
inclusion or not. While I have a certain feeling on that, I think the policy is could be taken to council that way. And at council, we can talk about if we want to include additional companies. So with that, I'll second what Preston said, with no changes. Director, I do leave it to you if there's
Something confusing.
particular phrasing in the way that we put it that would be better, that staff. You had a very elegant way of phrasing it earlier, and Preston did a great job, I think, translating it, but I'm not sure it all came through. So,
Wordsmithing is most welcome. Oh, well, I guess maybe I need to amend because the other part was having the value statement in the investment policy and then a reference to an ESG policy that would be external to that for implementation or realization of that value statement, which was suggested by.
do we have an
Portfolio manager.
ESG? I guess this is the ESG. Okay, yes.
So this is the
Sure.
implementation policy.
Yes.
We don't have the value statement. I would actually like to read.
Oh, you have a value statement.
I'd like to read something. I'm not saying it is it, but I would like to read it just to introduce it. We're not going to pass it. I'm not recommending we do anything with it tonight, but we bring it back in September. But I think it would be useful to say something in that regard tonight.
I'm gonna ask you to, don't read it yet.
Okay, sure.
Finance Director, does that statement, the statement that Councilmember Jordan would like to read, can that go directly to council, or does it have to go through this committee?
That's a great question.
Sorry, and to clarify, reasoning being, if it could go directly to council, then it could go directly to council with what we've talked today about, and then council would review both at the same time and adopt both at the time. Otherwise, my understanding is we would have to meet and talk about the ESG policy. We would have to recommend council pass it, and that would mean the actual direction on investments would have to wait until all of that is done. So like if the first council meeting that we could possibly talk about, what we started with is 3 weeks from now, right? We will never it would push it further out. Versus if it doesn't have to go through us and it goes straight to council, then it's the first availability on council, it could show up. Am I making sense? It doesn't wait for us to.
So.
That's why I asked you not to read it to me,
Yeah,
because
sure.
I
I
don't want to.
appreciate that procedurally. So there's 2 council meetings between now and this body's next meeting. I doubt it's going to be
Right.
on the next council meeting's agenda.
Unlikely to be the 1st September.
I mean, maybe 1st September, but I don't think the delay is.
So if we had, second week of September, would that give staff time to bring it to council for the 3rd week in September?
I think probably not, probably the first week in October.
So that would mean all of this would be first week of October.
Right, but the earliest it could be, and I'm not saying it would be the first week in September anyway, so
see.
it's a month different.
So then maybe a different question is there openings in our next meeting in September to have a conversation, more in-depth conversation and recommendation to staff on the statement?
So here's perhaps a slightly different approach, just from a
Okay.
procedural standpoint, and also looking at kind of what's on your agenda today in this meeting. I have been trained by many city attorneys and city clerks, so I can sometimes channel them. I think that direction from the committee today to bring forward an amended investment policy that says we do ESG, see investment policy, see ESG policy, and a draft ESG policy that says fourth part, C, et cetera. That's all within today's agenda. That's clear. We absolutely can bring that forward sooner rather than later. I'm not going to try to commit to a particular meeting today because it requires some further discussion. An option for both trying to move quickly and addressing the issue of a values statement, which isn't technically really on your agenda today, could be that you provide direction today to do the amended investment policy and the ESG policy with all its parts and bring it to council. At the council meeting, the council could adopt both of those. And if there was a request at that point to consider a significant, an amendment to the ESG policy to incorporate that, you could split that at that point and say, we're going to adopt version 1.0 of our ESG policy. We would like to then, council requests that it be scheduled for some future meeting, I'm not even sure if it's committee or council, an amendment to the ESG policy to consider a value statement of some, description, which then allows for more dialogue on that, but doesn't hold up the whole ESG policy. So it's just another way to sort of maneuver the components of it to do both, but to do them in a phased manner so you don't hold one for the other or try to really, accelerate through something that might just need a little bit more time. So that's another
I appreciate your answer.
strategy.
So, but what that tells me is you probably shouldn't read your statement because it's not on the agenda and it's not.
So I guess we're forwarding, I'm going to call it the ESG implementation policy. Call the ESG policy the part that goes in our investment policy. So we'd be, and what you said also brought to mind, you could probably check with us individually, actually. I was thinking because the ESG implementation policy perhaps should come back to this body just to check before we send it to council, because, I'm certainly can miscommunicate. If there's a desire to move that more quickly, I guess a way would be for you to send it to each of us individually, and we can just view it individually without talking to each other and make sure that we think that everything is comporting with the motion we made before it goes to council. No. Okay. You
Sorry,
understand?
what I,
you understand what I'm
what I was hearing was what we talked about before about
saying? I kind of wanted
part 4 of C, right? That can move forward, and then in addition to that, the
It's-
language that you wanted to read can be brought to council for discussion, and if council would like to implement it, then it would go through a process, and that might come back to us. It might just stay at the council level, but it doesn't. We can move forward part 4 of C without that part.
Yeah, my brain kind of jumped tracks, which was, on the implementation side, do we want the draft implementation policy to come back to this body? Or do we want to go to straight to council?
I think we have very clear direction.
Okay.
All right,
You said gently and respectfully.
all right, well then, that's good. In terms of the value part of it, I mean, I would prefer to discuss it here at this body. I mean, I feel like that's part of our job.
Yeah.
To, reduce work for the council. Now, obviously,
So
council can
the-
do whatever it wants with it, but
Well, when staff brings it, it could be a recommendation that it come back to us, we discuss it, and then we'll send it back to council. But it doesn't mean that we have to wait on part 4 of C to implement.
right.
Yes. Perfect. Yes.
Yeah.
Staff understands what we're asking.
I understand.
Thank you.
The Assistant City Manager understands.
Thank you.
The Investment Advisor has heard it. Madam Clerk, would you like to call the roll on this very
Actually, I have a clarifying
important?
question. So on the value statement, what would be coming forward would be suggestion for council to have the opportunity to consider whether there should be a value statement, not actually a draft value statement. Because nobody's drafted it.
That could be part of the recommendation of the committee today, that the report to council have the ESG policy, which is the piece that goes in the investment policy, the a draft ESG implementation policy, and a recommendation from the committee that the council consider whether or not they desire to add a values statement and the process for doing so.
Okay. I amend my motion to include that.
Committee Member Jordan,
Yes.
Committee Member Mickey,
Yes.
and the motion passes.
Well, thank you, staff. Thank you, consultants, for bringing always wonderful information. I feel like I have to go review my personal portfolio after every one of these meetings. Don't ever actually end up buying U.S.
not my
Treasuries,
intention.
But, so moving on, we'll move on to item 6, announcements. Any committee announcements? No. Any staff announcements? Yes.
I just wanted to announce at your next meeting, and we'll figure out exactly when the next committee meeting is. We certainly have the break in August, but will be a preliminary year-end results, FY25 results. So we'll have a sense of hopefully a preview of the audit findings. So that's just kind of the big next thing up for the committee.
Great, thank you. We don't take public comment on announcements, so with that, I will adjourn our meeting at 6:07 p.m. Thank you, everyone.